Ladies and gentlemen, good day and welcome to Hikal Limited Q1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Hiremat, Managing Director, Hikal Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, a very good afternoon to all of you, and thank you very much for joining us today for our Q1 FY23 earnings call. I am Samir Hiremat, Managing Director, Hikal Limited. Alongside me, I have Anish Swadi, Senior President of Business Transformation and Animal Health, Kuldeep Jain, our Chief Financial Officer, Manoj Mehrotra, our President, Pharmaceutical Business, Vimal Kurshetra, our President, Crop Protection Business, and Strategic Growth Advisor, our Investor Relations Advisor. We trust that you and your family are safe and well. I hope you want to go through our earnings release presentation and the financial figures for the quarter. These are available on our website and the stock exchanges. I would like to start this call with an update on the unfortunate incident which occurred at Surat Sachin GIDC on 6 January 2022. This legal case is still sub judice, and as things stand, Hikal is in a very strong legal position. As a result of the Sachin GIDC incident, the NPCB had given a closure notice to the Taloja factory. We had filed a writ petition, and the Honorable Bombay High Court has decided in the company's favor to resume operations at our Taloja site. As on date, the company operations are normalized and all plants are fully operational. I would like to As indicated in our previous call, there will be a stepwise recovery over the next 3 quarters. Some of the key points for the quarter gone by. Supply chain is still an ongoing challenge for the sector owing to the geopolitical situation, ongoing Russia-Ukraine conflict, and a lockdown in China. These factors have impacted the margins as expected and as outlined in the previous calls, resulting in steep increase in the cost of raw materials, solvents, utilities, and energy. Also, the rise in crude oil prices has significantly impacted freight and logistics costs. We are now seeing the prices of some of our key raw materials softening, and we expect this trend to continue in the following month. We expect this reduction of raw material prices to partly benefit in Q2. However, the majority benefit should accrue from Q3 onwards. We continue to create alternative local supplier base to minimize supply chain disruptions in the market. We are also investing in our R&D capabilities in order to handle increase in inquiries in both our businesses. Talking about the financial numbers for this quarter, the top line stood at 379 crores against 457 crores in the same period last year, recording a decrease of 17% year-on-year, predominantly due to inventory correction by our pharma customers and the disruption operations for the crop protection business. The margin pressure, as highlighted earlier, led to a contraction in EBITDA to 23 crores, primarily due to lower sales and product mix, increased input costs of raw materials, energy, and solvents. Further, under absorption of fixed costs during the quarter also reduced the EBITDA. Lower operating profits and increased depreciation on account of asset addition and marginal increase in finance costs in view of interest rate hikes resulted in a profit after tax loss of 8.9 crores. Hikal's long-term credit rating is maintained at A+ by ICRA. With a strong pipeline of inquiries in both our businesses and resumption of operations at our Taloja site, we expect a stepwise recovery in each of the coming quarters. Now I would like to hand over to our President Pharmaceuticals, Manoj Mehrotra, to take us through the performance of the pharmaceutical division.
Thank you, Samir, and good afternoon, ladies and gentlemen. I'll start with the financial update. The pharma business experienced degrowth in revenue of 18% with rupees 224 total revenue in Q1 FY23 versus rupees 274 revenue in Q1 FY22. This degrowth is due to the temporary demand softening for key products and challenge inventory correction by customers, which will by natural progression correct in the upcoming quarters. The EBIT of the division stood at a negative rupees 8 crore. Fall in EBIT is attributed to lower sales, significant increase in input costs, coupled with lag in passing the increased cost to the customer, and lower absorption of fixed costs. On the positive side, our business excellence initiatives have resulted in reduction of costs, which has helped in partially absorbing the impact of higher input prices. On the business verticals update, on the API side, we continue to add several new customers and strengthen our presence in new geographies of LATAM and Middle East. Our new product launches in anti-diabetic therapy areas have witnessed increased customer traction over last few quarters. With the softening of raw material and solvent prices, we expect sales and profitability to improve in upcoming quarters. We have about 10 products in the pipeline at various stages of development and plan to launch 3 to 4 products in FY23. CDMO. Our CDMO business continues to witness increased number of inquiries. We aim to increase the win rate percentage to fuel the profitable growth. We have received an order for validation quantities for 2 intermediates for a COVID drug from a global innovator company. We have also received order from a global innovator for an intermediate for a new chemical entity which is in phase 2B of its clinical trial. Our future pipeline for CDMO business remains robust with several new opportunities. On animal health, we work with several of the leading animal health companies and these relationships have been strengthened over time. We have commenced process development for a number of active ingredients that are part of the multi-year animal health project with a leading global innovator. As guided in the previous call, we intend to complete the animal health plant commissioning by the end of FY23 and start validating products in the following year. The future outlook, we have a healthy pipeline of CDMO projects which will add to the profitable growth and change in business mix in the near future. We are focusing on enhancing customer engagement through further intensifying our key account management, which will also lead to increased share of customers' wallet. We continue to work on cost improvement programs to lower production costs and improve overall profitability. We have also started experiencing softening of prices for some of our key raw materials, which would reflect in improved profitability in the coming quarters. Our focus remains on executing a pipeline which will result in profitable growth. We maintain that FY23 will be a year of consolidation where we would rebuild our business despite market pressures persisting and would deliver improved results in the second half of the year. Now I will hand over to Vimal for the crop protection business update.
Thank you, Manoj, and good afternoon all the participants of this earnings call. The crop business has recorded revenue degrowth of 15% year-on-year with 155 crore total revenue in Q1 FY23 versus rupees 183 crore in Q1 FY22. Decrease in sale on account of disruption in operations which we tried to minimize by undertaking the annual preventive maintenance at Taloja facility. The EBIT for the division was 10 crore in Q1 FY23, primarily on the back of lower sales, higher input cost of raw materials, solvents, energy, as well as lower absorption of fixed cost. Demand continues to remain strong in the domestic market, and there are also indications from our existing global customers for a higher forecast next financial year. We are also witnessing rise in inquiries from existing as well as new customers for potential collaborations. Construction of our new multipurpose plant is on track at Panoli. We expect to commission it in second half of FY23.
business vertical updates for crop division. In own product business, demand of existing remain intact from our key customers, and demand supply scenario remains favorable in the domestic market. We are getting good traction of new fungicides in the pipeline from customers. We are in a process of strengthening our presence in Europe and Latin America. We also continue to explore new product opportunities in the business. Presently, we are working on 5-6 products and are at different stages of development. In CDMO business, our CDMO business continue to receive new inquiries from new and existing customers. We are intensifying our efforts to strengthen relationship with customers in Europe, US, and Japan by further integrating key account management. Our future plan, as our Taloja operations has resumed, efforts are focused towards covering the production loss of first quarter to best extent over next 3 quarters. To ensure stable availability and better pricing of key RMs, we embarked upon strategic supplier-based development, de-risking the supply chain from China through backward integration. Now I would like to hand over to Anish for overall business outlook.
Thank you, Vimal. As Samir, Manoj, and Vimal have talked about our business and performance over the previous quarter and upcoming business pipeline for each of the businesses, which continues to be robust, I would like to reiterate the same message and conviction. FY23 is going to be a year of consolidation to prepare for accelerated growth for the company. We have faced some major headwinds over the past 2 quarters. However, we have been resilient through it all. During these challenging times, we remain committed and maintain transparency with all our stakeholders, which has helped us tide over these challenging times. I would like to reiterate that we have not lost a single customer or contract in any of our businesses during this period. While we have seen a dip in performance this quarter, we expect a stepwise quarter-on-quarter sales improvement with expectation of a normalized sales quarter from Q3 onwards. We are observing softening of raw material prices over time. With greater strategic planning and execution, we are ensuring higher throughput at improved costs. Pressure in Q1 was expected to be high as indicated, but we are confident of achieving an improvement in profitability quarter-on-quarter starting Q2. Our transformation journey, Pinnacle, is witnessing good momentum across both businesses. With the help of our consulting partner, we have taken various initiatives across the company to make Hikal go from good to great. Over the last several quarters, we have focused our efforts on cost improvement programs to absorb some of the impacts of higher input costs. At the same time, we continue the initiatives of the strategic builds for each of our businesses for future growth. This will help reach our bold aspirations of driving profitable as well as sustainable growth as our long-term vision remains intact. With this, we will now open the floor to the question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity.
Request to use the handset. There's a lot of echo.
Sure. Is it better now?
Yes.
Yeah. Thanks for the opportunity. First of all, given how the kind of degrowth we have seen in the first quarter, do you think we'll be able to at least match the revenue that we had reported in FY22 of around 1900 crores?
Yeah, I don't see that as a issue. I think that next 3 quarters will make up the lost revenue from quarter 1, which should be well above last year's numbers.
Sure. And Samir, given the kind of consolidation that we've seen in our revenues in FY23. What kind of growth aspirations do we have for FY24 and 25? Given the kind of base we have set now, and the kind of capex we have had, and with the animal health supplies will also start from FY25 onwards. So what kind of growth are we aspiring for 24 and 25?
So we're expecting going forward in the high teens, the growth to accelerate to the high teens.
Okay. But, given we had zero growth during FY23, don't you think the growth should have been higher? Because we have been aspiring for high teen growth for, past so many years, and, the kind of capex that we have taken is also pretty, almost double than what we have already been doing prior to FY20, and we have been doing quite a bit of capex. So, don't you think the growth should be higher for 24 and 25?
See, the plants will be ready by end of this year, right? By end of FY23, two big capexes that we're doing. So next year will be the ramp up of these two plants. Full utilization of the plants will start from FY24 or 24-25. So next year there will be growth, and the big jump will come in FY25 when the full utilization of these plants will start.
Sure. And, on the Taloja plant, is the plant operating now at normal capacity, or, how are things on that plant?
It's operating absolutely normal capacity. This entire quarter we have the benefit of Taloja plant full operation.
Sure. And, Samit, given, how things are shaping up on both pharma and agro side, if you can talk about the kind of product launches that we have planned for 23, 24 and 25 on both the segments.
So I'll hand it over to the businesses. I think they have the details. Manoj, if you can talk about pharma.
On the pharma side, we have around 10 products in development in the pipeline in various stages. We will launch 3 to 4 API products every year going forward, starting in FY23. But as we know that you start a little slow, and it takes 2 to 3 years for the revenues to peak. But the run rate of 3 to 4 products, APIs every year will continue.
So, but out of these 10 products, how many will be CDMO and how many will be under our own, our own products?
When I say products, I imply own products which are own APIs or the Hikal own DMS. On the CDMO side, we talk in terms of projects. So we will definitely have 2 to 3 projects going commercial every year. Like in the case of the animal health multi-year contract, what we have signed, that has 10 products, and every year we'll do 4 to 5 out of those. And going forward, those will actually have 10 products in FY25.
Sure. And on agro side? Yeah.
In the agro side, we will be adding in our own products 3 to 4 new products. And the CDMO side, we expect at least 5 to 6 new projects by FY25.
Okay. And one last question on the margin front. This year has been exception for us. So, prior to the kind of disruptions we have seen over the past 2 quarters, we have maintained that we are aspiring to improve our EBITDA margins by 1 to 1.5%, 2% every year from what our base was in FY22, or around 99.5%. So on margin front, how do you see things panning out for us for FY24 and 25? Let's forget about 23, given the kind of disruptions we are seeing.
From FY22 as a base, forget FY23 and with year of consolidation.
Sure.
Based on FY22, we expect 50 to 100 basis point improvement year on year on the margins from FY24 onwards.
So let's say in FY25, can we aspire to touch 20 to 23% kind of EBITDA margins, or it will be lower?
Yeah, I mean, if you add 50 to 100 basis points over 2-3 years, it should work out to approximately the same number. Yeah.
Sure. Okay. Thank you, and wish you all the best. Thank you.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Siddharth Grover from Equirus PMS. Please go ahead.
Hi, this is Viraj here. Thanks a lot for elaborate answers. Just a couple of questions from my side. The COVID drug that you talked about, I mean, is the size of the drug in the range of 50 to 100 million? Because, I mean, essentially the talk was that that drug has been, I mean, the Merck drug has been kind of slowed down in terms of production for all the Indian producers. Is this the same drug we are talking about?
No, we are not authorized to disclose the COVID drug which is there because we have confidentiality agreement. So at this point, the objective is to get into the supply chain of the innovator. And going forward, I'm sure this will have other indications as well. So, and once we start a relationship, things may change for COVID also, and things may change for other indications. So we have to really wait and watch.
Absolutely. Thanks a lot. And post the large capex that we have done, Sameer, what's the kind of top line? Earlier we were talking about close to 3,000 crore post the whole capex is over. Is that still the same number that we think we can do on the current capacity that we have?
So currently, I mean, we're investing about 300 to 400 crores of capex every year, right? So if you take an asset turn of about 1.5 for the new capex, if our baseline last year is 2,000, and you do an asset turn of 1.5 on the new capex, it adds up to about 3,000 crores plus.
So is the current capacity base revenue only 2,000 crores? That's the max we can do? Because I thought we were running at a slightly lower utilization.
Maybe a little bit tweaking and a little bit operational excellence improvements, 10-15% we can do. So debottlenecking exercises, 10 to 15%. But the capex that will start kicking in from end of this year will give us the benefit from next year, and the FY25 and FY26 will be the peak realization.
Okay. And if we sir, look at the commentary of some of the other large agrochemical players, we are seeing, I mean, at least they are indicating that the amount of inquiries that they are seeing is close to 1.5 to 2x of last year, and last year itself was a 2x over the year before. So is that the kind of traction we are also seeing?
Yeah. So we are also seeing the same traction, and we are also getting good inquiries from our existing customers as well as from new customers.
Right. And with the energy prices in the West being significantly higher, do you think some of these large MNC companies who have plant in Europe might look at shifting some of the lower-end products, because we are now just far more cost competitive, even in conversion cost compared to them? Earlier we were competitive in terms of manpower cost, but now even conversion cost seems to be far lower for us compared to Europeans.
Yeah, absolutely. We expect so. We expect that some of this capacity will shift to India.
Thank you so much, and best of luck for the future.
Thank you.
Thank you. Our next question is from the line of Ranveer Singh from Edelweiss. Please go ahead.
Yeah, thanks for taking my question. So just on Taloja facility, last month we received that quotes order and things are now operational. But when we retain customer demand is intact, then why that will take 3 quarters to normalize on revenue level?
See, that is on the basis of capacity available in the plant. So you can increase, some production in one quarter. So you cannot make up all the loss in 1 quarter. I hope this clarifies your question.
Okay, so the past loss would be covered in subsequent quarter, and then we will have additional sales. That's what we are saying.
Yeah.
And the guidance we are giving, so for FY23, we are expecting to end up at flattish revenue, right?
Compared to last year, yes. It's a year of consolidation.
So for a 1,900 crore kind of revenue, the rest of 3 quarters should have above 500 crore kind of sales. So additional 100 crore, and maybe because this is staggered, so end of quarter, the last quarter should have some, higher run rate than the historically we have been receiving. So what will drive that?
Sorry? So, the first question was whether they're going to achieve last year's numbers, right? Is that your first question?
Yeah, that is a question. Yeah.
That is going to have to be achieved in a staggered manner, so we'll be back on regular run rate by quarter 3, quarter 4. So, stepwise, quarter 2 is better than quarter 1, quarter 3 is better than quarter 2, 3, 2, and so on and so forth. So, also, one is that we're only talking of the crop business. So the farmers also want witnessed a slowdown in quarter 1. And that slowdown is now, reducing. The channel inventory has already been eaten up. So we expect sales to start normalizing by end of quarter 2 itself. And the full benefit will come from quarter 3 and quarter 4. So put these two together, and the Taloja plant and the agro operations running at full steam, we see the plants back on track, the business back on track from next quarter onwards. Fully, and we'll see huge improvement this quarter as well.
Okay, and the contribution of Panoli will start from FY24 first quarter, FY21 move forward?
Yes, FY24 first quarter, that's right.
Okay. Yeah, that's it, my side. All the best. Thank you.
Thank you.
Thank you. The next question is on the line of Pranay Delia from Panchtantra Advisors LLP. Please go ahead.
Good to hear you, Mr. Samir. Great to see you back, and I hope that these obstacles are only temporary for Hikal as a shareholder family. Couple of quick questions, sir. How much of current debt do we carry on our books?
Yeah, Kuldeep, my CFO can answer that.
We have 680 crore net debt today. I mean,
that's all term loan?
No, say 50% is term loan and then 50% is the working capital loan. So 400, 300, like at that term.
Just one sec. 400 and 300. Secondly, we've seen a sharp increase in interest costs. What I can make out is from the last call, you had guided that your debt equity ratio was 0.59 and cost of funds was 6.15. How much has that changed?
This has changed in the first quarter. It has changed minutely, just 18 basis points. But we expect to increase by quarter 2, quarter 3 more.
But by only 18 basis points change, and your interest cost has gone up substantially by almost 50%. So if your cost of funds has not increased so much, how can your interest cost go so much?
This includes some revaluation loss of the notional revaluation loss of the loans which we have taken in the foreign currency.
But that is not mentioned in your notes to accounts. It would have been prudent to mention it so that we can judge. It's sending a very wrong signal to shareholders. We are thinking that your cost of funds is all shot up all of a sudden in spite of your credit rating being maintained. And secondly, on the share valuation part, Mr. Hiramat was just asking, looking at the fall in share price, are the promoters considering any creeping acquisition to rest the value in the company? Hello? Am I audible?
Yes,
Hello?
it seems we have lost the management line. Pranay, we would request you to please be on the line while we reconnect them.
Yeah.
Participants, please stay connected. Thank you. Ladies and gentlemen, we have the line for the management reconnected. Pranay, may I request you to please repeat your question once again?
Yeah. Mr. Samir, on the second question, looking at the steep fall in share price, can we expect the promoters to do some creeping or the company to announce some buyback to rest the concern amongst the shareholders?
I can't give any comment on that, yeah?
Okay, fine. And best of luck for the future, and I hope that, whatever has transpired, and we do achieve whatever you set out on.
Thank you very much. Thank you very much. Thank you.
Thank you. The next question is from the line of Hitin Purisha from Joindre Capital. Please go ahead.
Hi, sir. Good morning. Thank you for the opportunity. Hello, am I audible?
Yes, you're audible. Please go.
Yeah. So my first question is, can you quantify the production loss which has happened in Taloja plant in revenue and in EBITDA, which happened in this quarter? What would be the quantification for that?
The revenue loss was around 50 crores for the quarter, and that has impacted the contribution by close to 20 crores.
50 crores in revenue and 20 crores in EBITDA, right?
That's right.
Okay.
EBIT, yeah.
EBIT, yeah. Okay. So my next question is on this revenue guidance you have given. We will definitely do 1950 crore kind of revenue in this year itself. So we are expecting like 500 crore kind of normal revenue from next quarter itself, from Q2 itself. So just wanted to understand this on the margin perspective. Are we expecting double-digit kind of margin from next quarter itself? Let's say 10% around.
Yes, on the margin perspective, definitely double-digit margin, and there is a stepwise increase in revenues to get towards the run rate of 500 plus per quarter. Average for 3 quarters will be above 500.
Okay. So we will do 10% kind of margin from next quarter itself, right?
I get to do better than that, yeah.
Okay. And sir, my last question is on the Taloja plant, which is going to start from next year itself. And you mentioned it will be starting in second half, right?
No, it's already started from early July.
Early July. My question is on the MPP plant. Sorry, Panoli plant. My bad, sir. Sorry.
Panoli plant is starting by end of this year.
End of this year. And what kind of revenue we are expecting from that plant, sir?
Well, at peak, it will be about 200 to 300 crores. About 300 crores at peak after 3 years of commissioning.
So the peak revenue number will come in FY25, if I'm not wrong, right?
FY26.
FY26.
Because it takes time to have some validation, approvals. It's a multi-purpose plant. So there are multiple products in that plant.
So the margins for these products will be similar to the company current margin, or it will be lower as the funding of the CapEx is also done by the partner itself? So,
see, as I've been mentioning on all the previous calls, any new project that we take, the margin profile is significantly higher than a historical margin. If our historical EBITDA margin is about 18 to 19%, all the new projects and all the new product selection is done based on higher margin profile, well in excess of 20%. So that is why the asset turnover ratios also for the new projects are closer towards 1.5. These are the basis of selection of new molecules and new projects.
Okay, 1.5. Yeah. Okay, sir. Okay, I'll get back in with you, sir. Thank you.
Thank you. A reminder to participants, please press star and 1 if you wish to ask a question. The next question is in the line of Jayesh Parekh from JMP Capital. Please go ahead.
Good morning to everyone. My question is for Samir Bhai. Samir Bhai, kindly take my question in a right spirit. If you see last 10 years, 9 to 10 years block of Hikal, in terms of revenue, we have just grown from 700-800 crore to 1900 crore. And in terms of operating margin, we have never crossed 20% operating margin in last 5-6 years. Only in 2012-13 we were 26%, 28%, and then we have never seen those kind of margin. And my second point was that our operating case generation has just gone up. Case from our operation has just gone up from 150 crore to about 290 crore for March 2022. So my humble request is that when in last, at least if not last 10 years, but in last 5 years, the chemical sector in India has performed very well when you see our peers into crop science business as well as pharmaceutical business. So can we find out what exactly is wrong with our beautiful organization with such a beautiful plant? that we are not able to grow in line with what is happening in the industry?
Well, it's a very valid question, and we are even more concerned than you are about this point. So we've done several things. We looked at our entire operating model. We've got a transformation program that we started last year called Pinnacle. We are looking at growing our business faster in line with our peers to improve our margins, also in line with our peers. So all the new projects, as I mentioned to the earlier speakers, are a much higher margin profile. They're winning the larger contracts. They're putting in significant steel in the ground and investing. So I think, yes, in the last 5 years, maybe we have not grown as fast as our competitors, but you will see in the next 5 years, they're going to catch up, and we'll be playing in the same level as the top 2, 3 in each of our fields. So the idea is to grow and accelerate growth in the next 3 to 5 years significantly, and the historical growth will be a thing of the past. And there's a lot of opportunities also today. Yeah.
Yes. Thank you so much, Samir Bhai, and my best wishes is there. Thank you.
Thank you.
Thank you.
Thank you. Our next question is from the line of Aditya Khemka from InCred Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. So if I look at your Taloja plant closure, I'm just a little confused. Does the Taloja plant only contribute to crop protection business, or does it contribute to the pharmaceutical business as well?
Only the crop protection business.
Okay. So then when it comes to the, and previously you had said that Taloja contributes 15% of revenue. So was that 15% of total revenue or 15% of only crop protection revenue?
15% of total company revenue, Hikal revenue.
Yeah. 15% of Hikal revenue. So that would be roughly 30% of crop protection revenue.
Yeah. The number, yeah.
Yes, I mean, given that they're broadly similar for crop protection.
Yeah. 30-35%, yeah.
Yeah. Okay. Got it. That's understood. And now on the Taloja plant itself, so given that we have not been able to supply our customers for one entire quarter, and obviously they must have consumed the inventory that would have been lying with them, I would have thought that, in the second quarter, we would run the plant double shift and sort of fill up their inventory as well as provide them enough material to continue supply this quarter. But from your statements, what I understand is we are going to restock the inventory not immediately in one quarter, but over the next 2-3 quarters in a slowish manner. Could you sort of help me understand why that is the path we have taken?
I'm Vimal Kulse. So this plant is a continuous plant. It as such runs in 3 shifts. And based on the capacity available in each quarter, we will make up the loss of quarter 1. So it is not possible to be done in 1 quarter.
Understood. Oh, that helps. It's a continuous plant. I was not aware. Okay.
It's a continuous plant.
Yeah. Okay, got it. So yes, in that case, it just totally makes sense. Second question on the pharma side. So we understand the decline in the crop protection business is largely now due to the Taloja closure, and therefore should normalize once Taloja normalizes, which you are saying is happening. But on the pharma side, you're basically saying that the customers had some inventory, and that inventory is basically getting depleted as they're not taking up fresh stock. And then with the depletion of inventory, you'll get more orders. What I understand is, could you help us with the product concentration on the pharma side? Our largest product, what percentage of revenue does it account for? And this question is for FY22. And then for that product, what is the situation in Q1 FY23?
So our largest product is around 30%. And
30 as in 30 or 13?
30 of the pharma business. And what we have seen that overall, not only this product, but other products, including the CDMO products, had excess inventory with them, which got corrected in Q1. By the very definition of inventory, the long-term demand is going to come back, and we have already started seeing positive outlook from the month of July, August. And we will get back to a normal sales in the next 3 quarters. That's what Samir also mentioned in the past.
Yeah, I get that. So this product, which was 30% of the pharma revenue in FY22, in 1Q23, did it maintain 30% contribution to top line, or was it significantly lower?
So our intention is to long-term bring it down to 20%. And this year we'll have to see whether from 30 will go to 25 to 28 in that range. The long-term prospect is to bring it down to 20 and launch new products with higher margins, which will improve the profitability trajectory of the pharma business.
And this is your own product, not a CDMO product, right? The 30% contribution product?
That is our own product.
It is an own product. And why is the contribution coming down? I mean, obviously one reason would be the growth of other products and launch of new products. But in absolute terms, it seems that this product is declining, right? So any reason why the product, I mean, again, inventory being one part, but is there an element of market share loss or competitor positioning in terms of better cost or pricing? Could you help us with that?
No, see, the long-term prospect of this product is good. We will maintain our market share. But since this is a mature product, the newer product will grow faster and this product will have a slower growth. So on absolute terms, this product will continue to grow. Maybe it will grow at 5%, 7%, but others will grow at greater than 15%. So by this arithmetic itself, the weightage will come down.
Fantastic. That helps. Just one last question from my side. When we say CDMO, does it mean that our customers are innovators and they have patented products or innovative products which have just gone off patent or maybe off patent already? Or do we mean it's products which may be innovator or generic, but we have helped developing the product?
No, when we say CDMO, it means we supply to innovators. They may be patented, KSMs to patented or new chemical entities which are molecules, or also part of life cycle management for the innovator. And either they can be APIs or they can be key starting materials. We also are into custom development where we work on phase 1, phase 2 kind of molecules, which will get launched in FY25 or 26 onward. And we have a healthy pipeline of these phase 1, phase 2 kind of molecules also. In fact, if you see, we have said that we have signed a contract for phase 2B launch with a global innovator company.
Understood.
Means within the next 3 to 4 years, it should get commercially launched.
Fair enough. So just an observation on that. So when we look at other CDMO companies, right, which have majority CDMO contribution, their gross margin tends to be closer to 70 and EBITDA tends to be closer to 30, at least for the CDMO segment of the business. And then they do the generic or the own product division where obviously numbers are lower. And therefore what we get to see is the Concall number, which is sort of the average between the CDMO and the generic. In your situation, if I assume similar numbers for CDMO, 70-30, which clearly doesn't seem to be the case, maybe it's even lower than that, is the generic or our own product segment in both crop protection and pharma really like below 10% EBIT or EBITDA margin business that we are running?
No. What I'll say that in our CDMO business, we have some life cycle management products which may not generate this kind of high contribution margin of 70%. But the NCEs or the new development which is happening, those will definitely have higher margins. So as of now, definitely the CDMO gives higher margins. Going forward, our attempt is to get more CDMO customers, invest more out there. From a level of 50-50, we would like CDMO to contribute 60% of our revenues, and margins will be higher than 60%.
That helps. Thank you, gentlemen, and all the best.
Thank you very much.
Thank you. A reminder to participants, please press star and 1 if you wish to ask a question. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity, and apologies for asking the question again on the historical performance. But in the last 4 or 5 years, we have seen that there could be an external event and it takes some of the quarterly performance for a toss. I mean, we have seen that when the Mahad, flood issue, after that COVID, then last quarter was hyperinflation in cost, this quarter inventory destocking. So what has the management, taken steps in terms of not such an aggravated impact on a particular quarter on the business. And an allied question is that during such cases of cost inflation, don't we have any mechanism to pass it on to the customers instead of taking the entire brunt ourselves over a period of time? Thank you.
Yeah, I think your question is in two parts. One is that yes, we had some external events. Some of them were force majeure related. I mean, the March flood was, COVID was definitely force majeure. I mean, it's not of our doing, and Taloja was also an unfortunate event that took place. But we've learned a lot from this event. We are de-risking our portfolio and our plants to a large extent. Percentage contribution from a single site or a single building on that site will come down. We're making alternative arrangements to move products around from one site to the other if such unfortunate events do take place in the future. So that's from a perspective to ensure that the impact on any external event could be minimized to a larger extent than what it is today.
Right. And the second part of the question in terms of the contracts with our customers from pricing perspective.
The contracts with the customers, many of them have pass-through clauses, and we are already in discussions with them, and it takes a lag of 1 to 2 quarters to get the benefit, but the discussions have already begun, and we expect those benefits to accrue in the remaining 3 quarters of this year.
But do we get compensated for the loss of opportunity or loss of margins for previous quarters, or is it only for the subsequent quarters that the pricing gets adjusted?
It depends on a customer to customer. Yeah, it's an ongoing basis. So, it's a little bit plus minus, but overall it's a positive for the company. Yeah.
Right. And second question is, I understand that from FY20 to 22, we have invested close to about, say, 600 crores in CAPEX. How much of that is reflected in our revenues of FY22? Just wanted to gauge in terms of how much potential opportunity that we are looking at to capitalize over the next 2-3 years from the 600 crore CAPEX. Thank you.
600 crores will be the investment by end of this year. I mean, between last year and this year will be the 600 crore investment. So the benefits have partially will come in this year, but the most of the benefits will come in from next year onwards.
Right. So just clarification, FY 2021 also we have combined spent close to about 250-300 crores. Is the entire benefit being captured in FY 22 numbers, or will get captured in FY 20?
It takes about 2 to 3 years, depending on the type of product, to get the full benefit. There's a ramp-up period.
Right. And just one last clarification. You indicated about the revenue guidance for FY23. In terms of margins, given that we had decimal margins for Q1, what would be our margin expectation, even if we were able to catch up in the next 3 quarters, averaging for FY23?
So we'll be in a position to give guidance after Q2 numbers.
Fair enough. No worries. Thank you so much, and best of luck, sir.
Thank you.
Thank you. The next question is a follow-up question from the line of Aditya Khemka from InCred Asset Management. Please go ahead.
Hey, thanks guys for the follow-up. On the CDMO part of the business, again, this raw material cost pressure, again, if I follow the trends from larger companies, Lonza, Catalent, and some of our local competitors, it seems relatively easy. When they talk, at least they say it's relatively easy to pass on the raw material cost pressure to CDMO customers, because they are, our production is a very small part or a very small component of their overall product and economics. But looking at our gross margin for the last 2-3 quarters, it seems that our CDMO customers don't feel the same way. So what I want to understand is it just a contractual bit where because of the contract we have not been able to renew the price of our output, or is it because our customers don't really want to entertain sorts of price increases that we have not been able to pass it on?
No, so to answer your question, CDMO customers, we are able to pass on the cost impact, but with a lag effect. And that lag can be 1 to 2 quarters.
And for the generic customers, as in our own product customers?
No, the generic customers, it is the market which dictates and the competitive pressures. So in the pharma API or the own product business, unfortunately, we have not been able to pass on the cost increases because everyone has not increased the prices. So there we have to kind of absorb. But going forward, since the raw material and solvent prices, we are seeing a softening trend, things will get better in the next few quarters.
How much case coming down there?
Sorry, Aditya, your line is audio is breaking. Request you to please come in network area or use a handset properly.
Yeah. So I'm saying, how much raw material inventory do we carry, KSM do we carry? Because the spot prices of these raw materials is correcting. And if we have still got high-priced inventory, we'll have to consume the higher-priced inventory first, right?
No, you're right. You're right on that. But we know when we know that raw material prices softening, we really don't keep much inventory.
All right. So the KSMs would start to reflect from the second and third quarter itself, right?
I'll say more towards the third quarter because many of the raw materials are imported. In case of imported, they are already on the high seas. And so 1 to 2 months inventory will be there for imported raw materials. But the full impact of softening of raw material prices will be shown in quarter 3 onwards.
I got that. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference back to the management for the closing remarks. Thank you, and over to you.
Thank you for joining the call, and I would personally like to thank all of you for your continued support to the company through these challenging times. I'm confident that the future is bright and Hikal will continue to grow sustainably in the coming years. If there's any further question, please feel free to reach out to us or to our investor relations partner, Strategic Growth Advisors. Stay safe and take care. Thank you very much. Have a very good afternoon. Goodbye.
Thank you very much. Ladies and gentlemen, on behalf of Hikal Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.